Hello, traders, and welcome to yet another episode. And today I want us to discuss about the ICT rejection blocks. So far, so good. We have been able to look at a different ICT concept from liquidity to order blocks to breaker blocks to mitigation blocks. And today I want us to look at the rejection block. Again, remember, trading leverage product carries risks, and the reason why you need to have a proper information or proper education or skill for you to be able to traverse through the financial markets. So I will again say that the rejection blocks, this is not my concept. I attribute this to my mentor, Michael Andelston, the author of ICT. And for me, it's basically to try and break it down into the simplest way possible for you to be able to understand, or for you to be able to be in a position that you can easily identify the rejection blocks, understand them, and you are able to trade them profitably. So when we talk about rejection blocks, definitely there are two of them. So all blocks are two types. So we have bearish and bullish. So we have the bearish rejection block, and we have the bullish rejection block. So when we talk about, maybe we can talk about the bearish rejection block. And a bearish rejection block is basically when the price has formed long wicks on the highs of the candles, and price reaches up above the body of the candle to run buy side liquidity out before the price declines. So what we talk about, you will find maybe probably, let's say, these are bullish candlestick. So we assume this is the price pushing up. Okay, so I'm going to demonstrate it in a very simpler manner for you to understand. So these are our candlesticks pushing up. So I'm going to put the wick there, right? That is the wick. And this is the lower wick. So we have the upper wick and the lower wick. And then now, we start entering a bearish trajectory. So maybe probably I will shade the bearish ones red, right? So we start entering a bearish trajectory. So then again, what we have is we may see the price now push up. So this is a bullish candle. We're gonna have it like that. That's a bullish candle. And then now we see the price push up, the wick push up, but sometimes it doesn't go above the body, or it's not actually supposed. Sometimes it does. It goes. We see it going slightly um above the body of that candlestick, and this is what we are calling bearish breaker block. So prices push above, right, the high of the previous candle body. So it pushes this the previous candle, and then the body that created the high here, right? So it pushes slightly above the body of that candlestick, and then now we start seeing selling program, right? Then now from there we start seeing selling program coming into place. So we enter the selling program, all right? So something like that. So for us of in ICT, basically this is what we are calling bearish breaker block, right? Bearish, not breaker block, but bearish rejection block. Okay, that's a bearish rejection block. So this is a bearish rejection block. So as you can see, when the price was pushing up to this level, it took out the liquidities of this previous candle. This was the previous bearish candle. So it took out the liquidities therein, right? It took out the liquidities therein. And then now the price came all the way to this rejection block, and this is where we get our sell, right? So if we are getting our sell from here, then it means our target. We are looking at the price probably coming to take out these sell side liquidities, all right? So that is the bearish rejection block. So when you talk about a bullish rejection block, so a bullish rejection block is when we have a sell program. So the price is dropping. So we have a sell program. We see the prices pushing on the downside, right? So this is a sell program. So prices has been pushing downwards. So these are the wicks of the candlesticks. So I'll put the wicks so that I can add some lipstick, as my mentor says, to add some lipstick in the charts. So that is the candlestick. So we have the sell candlestick. Then we have these last candlestick there. Then now we enter a buy program, all right? So we enter now a buy program. So I'm going to let this one be like that. So now we start entering a buy program. The market pushes up. Okay, the market pushes up. So it can push up even to create a BOS, all right? It can push up to create a BOS. So these are the wicks of the candlesticks. All right, so these are the wicks of the candlesticks. Can have it like that. This as the price pushes up like that. So that's another wick. So this is another wick. This is the lower wick. This is the upper wick. And then we have this lower wick. So as you can see, the price has created what we call a BOS there, right? So we see the price creating the break of structure. All yeah, these might be because we were in a sell program. These might be not a break of structure, but we are looking at the price creating a change of character. So we have that, which we can call it a change of character. All right, so this is a change of character. So right now, after that, then we start seeing price now shifting and then now pushing into the bearish sentiment, right? We see the price starts to retrace. I'm just drawing them clearly so that you're able to understand these concepts outright, right? So we have that. Then we have that, right? So again, I will do the wicks here so that we can add some lipstick in the charts, as my mentor says. So we have that like that. Then we have this one. Then we have that one. So these are the wicks. But what is enticing is now I want us to look at how the wick of this candle will do, right? So as you can see now here, so this candle takes out the highs or the lows. It takes out the lows here, right? So it takes out the liquidity there. Then it comes into this rejection block. So this is our rejection block, right? So this is our rejection block, right? That's our rejection block. So we mark up to the lowest wick. So this candle draws the wick, and this wick basically goes slightly below the body of this candlestick here, but it doesn't go below the wick. It doesn't take out the liquidities here at the wick, right? So that's what now we are calling as bullish breaker block, all right? So this is what we are referring to as a bullish breaker block, right? Which you can use, not bullish breaker block. I don't know why my mind is on breaker blocks, but that's a bullish rejection block, right? That's a bullish rejection block. So, and basically now we can be able to take our buys from this particular level, okay? So we come there, you take buy entries. So you have, I don't know why this is so elongated. You have your stop loss slightly below the zone, right? You have your stop loss slightly below the zone. And then we will be targeting the price to take out the liquidities, all right? So we'll be targeting the price to push up to this level to take out the liquidities that the price left there, the buy side liquidities that the price left there. So that's how we will have our setup. Okay, that's how we will have our setup. So for this bearish breaker block, definitely we are going to have our setup like that. So that being our entry. So we have that being our stop loss slightly above the zone, like that. And then now we have, or we target these lows here, like I said, okay? So we want to see the price now drop all the way to this particular point. So that's how to identify bearish rejection block and a bullish rejection block. So they are quite straightforward. So they ain't that much difficult. But remember, for them to be valid, again, we are looking at either having a change of character. All right. So the price creating a change of character, or maybe a BOS, then retracing down all the way to this particular level now to create the rejection block, all right? And remember, sometimes you find that this rejection block will always be anchored in maybe probably where we have the order blocks, because this is an order block by itself. This last candle, this last sell candle, this is an order block by itself. So sometimes the price can dig deeper into the order block, basically to retest the rejection block, and then we see the price pushing up. So the reason why we need to really approach this concept with the proper risk management, because you never know what might really, whether the price is going to tap the order block, then fly, or maybe probably the price is going to dig deeper to retest the rejection block. But the rejection block should be your last results in the order block in terms of you eyeballing your buys, all right? Or maybe probably you eyeballing your sells, where if you are using the bearish rejection block. So you find that, so you find that trading ICT rejection blocks, for you to be able to trade them effectively, it requires a clear understanding of price action, market structure, and also the liquidity concept. So all ICT, I might say actually all ICT blocks, all ICT concept, you really need to have understanding of price action. You really need to have understanding of market structure. And the reason why, when we begin looking at the ICT, we begin the basics. We begin by looking at the market structure. When the market is creating higher highs and higher lows, that's an uptrend. When the market is creating lower lows and lower highs, that's a downtrend. So also you want to look at where we have maybe change of character, where we have a shift in market structure, where we have the BOS, that is the break of structure. So those are the very basic terminologies that, or the very basics concept that you need to understand in ICT for you even to be able to trade these blocks or points of interest effectively. So maybe to maybe probably shed more light on the rejection block. So you find that these rejection blocks, there are always specific areas on the charts where price has previously faced a strong opposition, especially maybe support or resistant zone. So you can use even you can get the rejection blocks maybe in supports and resistance zones as well. Basically, the key thing is when you're taking a setup or when you're taking a trade. Again, there has to be confluence. The reason why I always propagate for at least two reasons or more, right? The reason why you are taking maybe a buy and all sell. But the moment you see yourself maybe supporting having just one reason why you are selling or buying, note that that is not a high probability setup. Like for instance, in this scenario, you can see this is an order block and also we have a rejection block. So that gives us at least two confirmation. We might say maybe, let's say if the price has, if we had pushed back this way and we see price has been respecting this level, we might say that we have a support level and we have seen a rejection block, and therefore that gives us at least two reasons why we can be able to engage. So you find that when price approaches these areas of rejection block, there is a high probability that the price will get rejected again. The reason why we are now calling it a rejection block. So this rejection can basically signify that institutional players, that is the big banks, the smart money, are actively defending a level, making it an ideal place for entries aligned with the overall trend. Okay. So some of the key characteristics of these rejection blocks, they are formed after a strong move in the opposing direction. So you can see this is a strong move, right? This is a strong move in the opposing direction. So the market was in a downtrend. Then we have a strong move in the opposing direction, which is an uptrend. Then the price comes back to this level. And therefore, we want to see the price reject or start pushing up from that particular level. So they are usually found at the high or low of a consolidation zone or at levels with previous rejection weeks. And they can be in line with the market structure shift or maybe probably change of characters or, for instance, a previous support turning into a resistance. So we are going to look at all those, some of the examples in the charts, okay? So for you to be able to identify these rejection blocks on the chart, so we are looking at highs and lows. So that is basically the market structure. We want to see the liquidity zones, and also we want to align them with the order blocks. Okay, we want to align them with the order blocks. Like you can see, like I said, this is an order block. Okay, so maybe I can mark it so that you can see, but I did a video about the order block, so you can just check it. So this last sell candle here, this is an order block. So we have 2 points of interest here, the order block and the rejection block. Okay. So now the moment we are able to identify these levels, so the key thing is for us to wait for the price to retrace. And then we can add some confluences like the order blocks, like maybe these being a support level. All right. So because again, confluence is very important when it comes to trading. All right. So let's look. So I've been able to show you how to enter the trade. So the moment the price taps that, the rejection block, so that's when we want to enter the trade. So you can take your setup there, and your stop loss is slightly below the rejection block. And your take profit, we are looking at the highs that the price had created before these retracement. So that is what we will be eyeballing for our take profit. All right. So what I want us or what I want to do, again, remember before even we go to the charts, we try to look at these order blocks, I mean rejection blocks. Remember the time of the day is very important. When we talk about ICT, it's time and price theory. So we want to see the price coming to these rejection blocks during the kill zone. That is probably the Asian kill zone, or maybe the London kill zone, or the New York kill zone, or maybe probably the London close kill zone, right? So let's now go into the charts. We try and identify. So remember these rejection blocks, they will form in all time frames because again, we say the price is fractal. Okay, price is fractal. So I want to go to a pair. Today, let me use a different pair, even though I normally use I normally I light all those stuffs in GB in gold, but we can be able to look at a different pair. So this is gold. I mean, this is GBP USD, and actually, by the look of it here, we are able to identify a very nice rejection block from the weekly time frame. So we see price create that, right? So the price was in a downtrend. So at this point, we see a shift. This is where we have a major high. So here we see a shift or a change of character reversal from downtrend now to uptrend. Okay, so this is where it is. Then now after that, we are in an uptrend. So the price is creating higher highs and higher lows. Okay, higher highs and higher lows. But again, at some point here, the price let me show you that. So when we are looking at the trend, first of all, you'll find that there are some minor structures within the trend. So, but for me, this is how I would mark this, all right, like that, like that, like that. So that's it. So here now we can say we have maybe probably we are seeing a shift in market structure, right? Or maybe a change of character because this is now the major low point, right? The major low point. And the reason why you see price retracing from this particular level, because here we have an order block, right? Here we have an order block and actually a rejection block. But let me show you this first rejection block that we have here. So from the weekly time frame, you see this particular level here. So we have a rejection block there. All right. So this is the body of this wick of this candlestick. So we are looking at the body of this candlestick. So as you can see, the price came to that level slightly, right? Pushing slightly below the body of these candlestick, right? Pushing slightly below the body of that candlestick, but it didn't take out the liquidities of this candlestick, but it took out the liquidities of this. And also here we have what we are calling this is an inducement, all right? We have an inducement, or we can call it even the sell side liquidities, however you call them. So the price takes out the sell side liquidities, taps into this particular level that we have here, that is the rejection block. So within this rejection block, we also have an engulfing, bullish engulfing. You can see the bullish engulfing. So this is how we mark the bullish engulfing. All right. So those are two confluences already. And we can also say this is an order block, all right? This is an order block, the last sell candle there before we see the price pushing up. So the price is coming to retest that level. So we have three confluences, all right? So then now that means this is a nice entry for a buy. So this is how we position ourselves for a buy. We have our stop loss slightly below the rejection block. So these are bullish rejection block. And we get our entry. So with this entry, therefore, we were anticipating or looking at the price coming to these particular levels, all right? So the price pushes to this level. Let's see whether we have maybe the price take out liquidity. So this is 34. The high of this is 34, 30, 34, 34. The high of this is 34, 44. So these has taken out the liquidities, right? So if you look keenly, you'll realize that this price has taken out these buy side liquidities. So that would be our target. So we have taken a trade from these bullish rejection block. So the first target, definitely before we look at the price coming to this level, so we can see this is an immediate high. So that's where we have the first target. Okay, that's where we have the first target. Then now we can look at the second target or the second TP for the price to come and take these buy side liquidities, right? So that's how we get that. So that gives us about a risk to reward ratio of 1 is to 18.64. But remember, this is the weekly time frame, right? So now this being the weekly time frame, so I want us also to delete these setup so that now we can look at the price action that is happening around this point that we formed a rejection block. I know sometimes it might be difficult to trade from a weekly time frame, but now we are using this weekly time frame to guide us now in terms of the bias, all right? So the bullishness, the bias. So we go maybe probably let's drop to the 1 hour time frame, right? Let's drop to the 1 hour time frame. So this has been our setup, right? From the higher time frame. So from the higher time frame, the weekly time frame, this has been the level, all right? This was the rejection block from the higher time frame, right? The rejection block from the higher time frame. So this is our entry. So I want us to look at this price action that we have. So, and try to see how we could have maybe gotten more entries as the price also even pushes up. Okay. So remember now the weekly time frame, when we go to the 1 hour time frame, we might have downtrends and uptrends, mixed structures, all right, mixed structures. So let's look at this level around here. So we see the price pushing down, okay, after creating these BOS. So this is where we have the rejection block, all right? So that is where we have the rejection block. So the BOS is at that particular point, okay? So now once we have that rejection block, did the price come to that point at some time? That's what we want to verify. So the price didn't reach to that level, so no problem, right? So let's push. So I'm looking only the rejection blocks. All right, I'm only looking at the rejection blocks. So at around this particular point, let's see what we have here. So the price pushes up, right? The price pushes up. So then now we start to having a downtrend. Yes. So here you see now we have the price creator BOS, right? So this was the low that the price created. We have that BOS. If you're looking even at the low of the day itself, so this is where we have the BOS. And look at where the price is pushing up to, right? So what do we have at this particular point? This is a rejection block, right? That's a rejection block. Okay, that's a rejection block. So the price doesn't push above the wick of this, but it pushes slightly above at the body of this pin bar, right? The body of this pin bar. So then there we have a bearish rejection block. So we're gonna take that trade. So like that. Okay, so we have it like that. Then we have our stop loss slightly above the zone. Okay, our stop loss slightly above the zone. So here, how are we going to eyeball our targets? So for the price, how we normally look at it, for the price to come to this level, where the price originated. So it had originated to these lows here. So that means that our first target will be these lows, which gives us a risk to reward ratio of 1 is to 7.15. All right. So from there now, we can look to the left. All right. We can look to the left. And when you look at to the left, we have some major liquidities here, right? So that could be maybe probably be the next target. Okay, that could probably, especially maybe if you are swing trading. Uh, Even up to that point, that is just enough. Because for me, when I take setups, I'm basically looking at a risk to reward ratio of 1:2 or 1:3. Okay. So at least 50 pips move. And you can see looking at it, 50 pips was around this particular level even before we hit the TP here. So even up to that point, it's just okay. All right, that's just a profitable setup. All right. So then look again at this particular point. So we have the price that creates the BOS here. All right. So we have that break of structure. So we can push these to the side. It was a successful trade. So we have that the price that create a BOS at that particular point. So then we see the price push down, then push up again, right? So where is the price pushing up to? So we have this rejection block, right? There we have a rejection block. So we see this price coming, pushing the wick of this candlestick goes slightly above the body of this candlestick. So there we have a rejection block, and probably this particular point, maybe we could have eyeballed an entry, right? We could have maybe probably eyeballed an entry, maybe probably a sell entry. But at this point, maybe you find that the price is beyond the kill zone, so there is no need of maybe trading that setup. But again, it's a valid one anyway, irrespective. Now the time is not the time the price comes to this particular level. It's almost when the market is closing up, and then it drops about 74 pips the following day, right? So that's not really appropriate. Okay. So then look at this particular scenario. So the price retraces. Remember the price now here is pushing on the upper trajectory, all right? So what we have around this particular point is see this level, we see the price this particular point here, right? We have that rejection block. Okay, we have that rejection block. So the price taps into the rejection block during the land and kill zone, and then we see the price pushing up. Remember, anytime we have a bullish, let me delete this first. Anytime we have a bullish trajectory, so this is how we anticipate the price to behave. So we anticipate the price to open up. Once it opens, then we see the manipulation, especially during the Asian session, we see the manipulation. Then the price will right around distribute, okay? And then we see the price close at that. So maybe probably I'll do a video to explain these power three. So this is the same scenario. So we see the price opening here during this day. Then we see the manipulation, right? So the Asian session creates the low of the day. So instances when the Asian session creates the low of the day. So definitely, we anticipate maybe the London session to be a retracement during to be a retracement to the Asian session. And this is what we see. This is the Asian session, the Asian low, the low of the day. And during the London session, the price retraces, right? So here, you can look at it maybe like that. You can take your Fibonacci. You have the low here and the high here. So you can see during the London session, the price comes to the optimal trade entry, and you have your buy. So irrespective of that, then what we have around this particular point, that's why I was trying to mark now a rejection block. Okay, so there we have a rejection block. So bullish rejection block. And then now we take our trade comfortably, a buy setup comfortably, price and time theory during the London kill zone. Okay, so then we see the price push up. Of course, we are looking at about up to this high is 35 pips. 39 pips. To this high here, we are talking about 56 pips. Okay, so let's see maybe a risk to reward ratio of 1:2, where it is, okay, whether it's a probable setup. So risk to reward ratio already this is 2.73. So risk to reward ratio of 1:2. Yeah, so targeting these highs here. Okay, targeting the New York highs of the previous day. Okay, so then we have our target there. Of course, now we'll be looking at even these highs of the previous day. And that's how you eyeball that entry at that particular point using the bullish rejection block, right? So let's push, maybe see whether we'll be able to identify more of that. So let's see whether we'll be able to see more of that, more of that, more of that. So this particular point, okay, this particular point. So we have let's see. So we have this particular, right? We have that. Right? The reason I'm marking that is because you can see we have a change of character there, right? We have a change of character there. I mean, not a change of character, but we have a BOS, that particular point. So then this is where the price is coming back to. Look at the time when the price is coming back to this level. It is during the Asian, I mean the London kill zone, right? It is during the London kill zone here. Okay, so then you see the price now drop, right? So let's see whether maybe this is a good entry, giving us a risk to reward ratio of 1:2. Let's see. So if we are selling from here, definitely for us, we'll be looking at the price coming to this level, right? Maybe we'll be targeting the sell side liquidities there. So that's at 3.76, which is quite okay. But now sometimes the price may not be able to reach to our destination or to our target. So how do we do? So how I do this is once the price gives me a half of the move of my target. So I usually take partials and put my stop loss at break even. Okay. So like in this scenario, maybe I'm targeting this loss. The price went past a half of that. But if you look at that, a half is actually more than 1:2 risk to reward ratio. This is 2.48. So, but now because I'm targeting maybe these particular levels, so once the price gives me, this is 3.79. So once the price gives me around 1.5, they're about 1.6, 1.6 there. So basically I take partials and put my stop loss at break even. And therefore, in case the price retraces like it did here now, it retraced, therefore it will hit my stop loss at break even. And I have already paid myself something, a half of my target. It's already banked, right? So that's a bearish rejection block. Okay. So then see when what the price is doing. So we see the price creating what? We see the price pushing up. Okay, so the price pushes up. So once it pushes up, we see the price create this. So we have that, which is more of a market structure shift. And on that market structure shift, we have the rejection block. Okay, so the price pushes to the rejection block, right? So we have a bearish rejection block. And then now we see the price push down. Okay, so the time of the day, this is at 2 a.m., right? So 2 a.m. 2 a.m. is mostly let me see. So when we are talking about 2 a.m., so 2 a.m. is when the London kill zone is beginning, right? So the London kill zone begins at around 2 a.m. So the open of the London kill zone. So the price jumps to, because you can see this 2 a.m. New York time. So the price jumps into that level. And then now we take our setup, right? We take our setup all the way down. Of course, you are targeting these liquidities here, the previous day's low. and our stop loss needs to be there slightly above that point. And you can see to that level, we are talking about risk to reward ratio of 1 is to 6.21, right? 1 is to 6.21. So my target, maybe probably we are targeting these buy side liquidities there, right? So, and you can see how the price did that quite nicely, right? The price behaved quite well. So, ladies and gentlemen, that's the rejection blocks. So make sure that you practice because practice is what makes perfect. And like we have said, you want to align these rejection blocks with order blocks. You also want to align them with areas of support and resistance. So for a bearish rejection block, you want to align it with maybe probably a bearish order block or a point of resistance. For a bullish rejection block, you want to align it with a bullish order block or maybe a point of support. Okay, so so that now you can come up with a confluence, all right? So as you can see, they are not really hard to identify. They are quite pretty forward for you to be able to identify them. So the challenge that I'm throwing to you is try to backtest them, backtest as many as you can, and make sure to comment in this video how you find it, and maybe probably any other thing that you might want me to look at or probably to discuss. So until next time, see you and keep safe.